It's now recording. All right, market internal. Let's take care of this stuff first here. Anything we're doing is purely for educational purposes, not giving any trading advice. This presentation is going to basically show how myself and Becky, who's the co-host and my trading partner, how we approach trading the markets and profiting from the markets using options. And for this particular week, and how we use options conjunction with the market internals. All right. Those of you who are not familiar with it, these are overall all the different sectors which we trade with options. But for the market internals, we're going to be focusing on the major indices. So it's going to be the Dow, NASDAQ, and S&P. Those are the three major markets which we trade with market internals: Dow, NASDAQ, and S&P. And that also includes the industrials with XLI. And now we have one other one that we trade with the XLK. XLK is a lower priced version. It's highly correlated with the QQQs, but the QQQs are a little bit on the expensive side for some people. So XLK is an alternative for trading QQQs, and XLI is highly correlated with the Dow. So it's an alternative to trading DIA, which can be really expensive. So XLI is an alternative to DIA. And in our trading plans, we'll have stats for each one of them, win-loss stats. So you can make educated decisions which to trade, or if you want to trade them or not, based upon the win-to-loss stats. All right, slide down a little bit. Put call ratios. And what are market internals? There are several different market internals, and the one we focus on is the put call ratio. It's not something that by itself can be utilized, but when in conjunction with other technical analysis methods can give you a really, really strong trade signals, because it's a sentiment indicator. So what this website shows, the CBOE, Chicago Board Options Exchange, each day they publish the put call ratio. And as this first value we see here on the site, the put call ratio, it's the total number of puts traded versus the total number of calls traded in the market. Overall, all the puts compared to all the calls, that is the put call ratio. Okay. Let me see, I've got a couple of questions here. Do you have ever compare/ES put call ratio? We only do options on the ETFs. We don't look at any options on futures. So to answer to John, no, we only look at options on ETFs, not options on futures. There are some strategies where we trade the futures in place of the ETFs, but those are completely different strategies. Okay. So the put call ratio is a sentiment indicator. To give you a little bit of history, how we started doing this, is something we learned from John Carter and Hubert Centers. We used to trade the put call ratio back in 2007, 2008, when the markets were going crazy. We'd have several thousand point swings in the market from day to day, minute to minute to minute. Markets would swing hundreds of points during that 2008 collapse. And during that time is when we were using the put call ratio. And we did it on the futures. And we literally never had a loss doing it on the futures. We would literally put a trade on at night, wake up in the morning, money in our pockets, just consistently. And how we learned it from John and Hubert is, if the put call ratio is above a certain level or below a certain level, it means there's an extreme number of puts traded compared to calls being traded. Okay, Now, we don't know if we're more puts are being bought, if puts are being sold. We don't know if calls are being bought or if calls are being sold. We just know that the ratio of one to the other, when it's between a certain range, there's nothing to really think about. But if it gets above 1 or below 0.85 in the ratio, then there is something more going on that's outside of the bounds of ordinary. So we trade when the put call ratio is up here or when the put call ratio is down here. That we use as a confirming factor for our trade setup. So for what we do is, this is purely a long strategy. We do this purely for buying call options. And the put call ratio for our approach to trading comes into play after the market has made a decline. So the market had to have come down. And then this tends to be one of our first buy signals after the market has made a decline. Okay. So today we're going to show you a couple of examples and of that. And in the handouts, I specifically listed all the trades on the QQQ, going back 15, 16 years or more. Well, we trade the Qs, DIA, SPY, XLI, and XLK. Those are the only ETFs we trade with that. Those have the most option volume and they're very tradable. Qs are the best, absolutely the best to trade. The same way we traded NASDAQ was our #1 thing we did with futures. We did back in 2007 and 8 with the put call ratio. Compared the ETFs, the NASDAQ is still the best. Okay, so but other ones are great also. So we'll take a look at some of those stats. But you have the link on in the chat window for the CBOE put call ratio. They publish this every afternoon after the market is closed. This information is published on this website at the CBOE. And it's literally the only one we're using is a total. They have different types, the equities, they got different put call ratios, but and different ones for the indices, but we're looking for the total, all encompassing, total combined put to call ratio. Okay, that's the only one we're using, this very first one. There are some companies out there that specialize in this type of approach with individual stocks also. You'll find that Thinkorswim lists the put call ratio for individual stocks because people use that information, not in the exact same way we have it here, but there's one company, I won't name the company or who runs it, but what they do is use words like unusual option activity. That is the type of words they use. They give you trade signals based on their software showing unusual option activity. If you can figure out who that company is, you can find it, but they use unusual option activity as the indicator of which stocks in their portfolio is set to move higher. It's the same type of approach we're doing here, but they do it with individual stocks because it's the sentiment saying that people in the know are placing big option bets on this particular instrument moving in a certain direction. And when we combine that sentiment with our buy signals, which usually occur when the market has made a decline and we see a buy signal, when you combine the two of them, then it works for us really, really, really well. Let's see, what did John, does it rhyme with maybe, John, quite maybe. Just saying, maybe it might rhyme with that, yes. But no, I've never looked at specifically the /ES put call ratio, just the ones, just the overall. The only put call ratio I look at is the overall put call ratio, and then apply it to our buy signals on those 5 ETFs which we trade. But yes, I like you know exactly who I'm talking about. but that's what they do. But the more you learn, the more you figure out what it is people do, but they don't want to tell you how it is, because then you can do it yourself, because Thinkorswim publishes that information, but they don't want you to know that. But all the information people use is all public, right? So for this particular strategy, we do 6 put call strategies, 6 market internal strategies, long only. So I'm going to go over one of them today, which we do 1 out of 6. And if you want to learn more, contact me and we can set that up. And this is going to, the strategy is simple. Some of you have seen our T lines in the past, and we have multiple future strategies and ETF and option strategies using the trigger lines. All right. And it's going to be a bullish cross on the T lines. I'll have the image here and I'll switch to the live charts. And then using terminology from Jake Bernstein, it's setup, trigger, trade management. The setup is look for a bullish cross on the T lines. The put call ratio on that particular day has to be equal less than 0.85 or equal or greater than 1.0. Okay, that's our setup, that's our trigger. That is it. Okay, it's a simple strategy, but it works extremely, extremely well because of how we utilize the market internals in conjunction with the technical buy sell signals. Okay, so now I'm going to switch over to the chart. Along the way, if you have any questions, let me know, and we can stop and address them. Any questions at all? Here also on the handout is a list of trades for the T lines, specifically on the QQQs, going back to 2006. So what's that? 17 years worth of trades. Yeah, about 17 years worth of trades, 16 to 17 years worth of trades on this particular strategy. Keep in mind, we have 5 ETFs and 6 strategies. So if you do the math, you can figure out how many potential trades there are. This is a strategy, or the market internal is something you can add to your overall trading portfolio, and it can add extra trades to your monthly trading plan. So whatever you're doing, this can add to it. You may not want to trade this alone because it's only maybe 3 to 7 potential trades a month. But if you add it to it, then you can get a lot more additional income opportunities, because there's a very high win to loss percentage when the trade signals do happen and confirm with the market internals. All right, I want to switch to the chart, and then I usually start out on the charts by doing a big picture review, and then we'll get into the daily, the strategy. So you should be seeing a chart now. This is the S&P 500, and this is the monthly chart. So every candle is 1 month. Every candle is 1 month worth of time. Okay. This blue line is a 40-period simple moving average, monthly 40-period simple moving average. You're going to find a 40-period moving average on almost all of our charts, whether it's monthly, weekly, daily, or intraday. The 40 is almost always on there. We started using a 40-period moving average when we met a gentleman named Oliver Velez. Oliver attended a lot of his presentations, used to go to the Traders Expo and money shows, and then watch a lot of his videos and online presentations. And the 40 was something he started using, and we started looking at how he was using it, and it became a staple in our charts as either a line in the sand to indicate bullish or bearish, or an indication of trend. So if a 40 is going up, we are trending higher, that type of thing. Or if we're below the 40, we have more of a bearish bias. If we're above the 40, more of a bullish bias. So we've used the 40 in almost all of our strategies as a trend indicator, right? So let's go through this now. Big picture, we are right here. We are back all the way in 1999 when the market is going up, 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 and then we had this crash in 2001. So usually on a monthly chart, if we see 2 consecutive closes below the monthly 40, there's a good chance this market's going to go lower. Good chance, and that's what happened. The 2001 market crash. It went down, 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 and this was 2003. It started to recover. And then we're back up above the 40. This was in 2003. So from this crash that started in 2001 and recovered and got back above the monthly 40 in 2003. Then comes the massive uptrend, massive uptrend, massive uptrend. Remember, every one of these is 1 month of time. These are years going by with the market trending higher, trending higher, trending higher. And this was the debacle in 2008 when the market just collapsed. Okay. Once again, 2 consecutive monthly closes below the 40, and good chance it's going to go lower, and it did. And this was 2008. Especially October was the worst month, but it just collapsed in 2008. And it didn't recover until middle of 2009. 2009 is when we started this rally, and then it got back above the 40 in 2010. Went back below briefly, went just lower just a little bit, but then it rallied right back up above the 40. And we've been in this uptrend since. Every couple of years, we will see a pullback to the 40. When this starts happening, keep in mind, this is 1, 2, 3, 4, 5 months of the market declining. During these 5 months, if you turn on the news and they're going to be telling you the sky is falling, everything's collapsing, everything's awful, the world's going to come to an end because of everything, and then we get below the 40, right back above. The reality is, in an uptrend, you're going to get pullbacks. When I look at the big picture, if I was a long-term investor, not a trader, but a long-term investor, on every single pullback to this uptrending 40 is when I'd be looking to establish a long-term investment position, because we're in a massive uptrend. This is major support. Every pullback is an opportunity to invest, not trade. This is for the long-term investors. This is when you'd be looking to put positions on those pullbacks to support, long-term support and uptrend. Goes on again, massive, extreme uptrend, okay? And then it took a couple of years now to even pull back to the 40. Big uptrending monthly 40, pulls back, continues in the trend. When it's pulling back, once again, all the media organizations are telling you trying to panic you for whatever reason. Keep in mind, if they're telling you the sky is falling, the people who are on those shows, on those news stations, like CNBC and all those, they're either have a product they're trying to get you to invest in some way, shape, or form, to buy their services in some way, shape, or form, and a network is just selling advertising space. They need to put something on exciting to make you watch, and they sell. That's how they make their money. They don't. They live in a moment. What's happening that day is what they report on. They don't show you this. They don't show you big picture. They show you what's happening that day. If the market's down 1,000 points, that's all they talk about. They don't show you the big, oh, it's down 1,000 points, no big deal, it's pulling back to support. They don't show you that. They just try to excite you and get you all riled up. But then the next day when it's up 1,000 points, you don't even hear about it again, because we're back in the trend. But they will excite you. It takes years for the market to go up. It takes weeks for the market to come down. Years to go up, weeks to come down. That's the way it is. It comes down quickly. All right. Back in the uptrend, this is 2017, 2018, 2019, 2018, it pulled back to support levels, right back above, and kept going. This was when everything shut down in 2020, at the beginning because of COVID. This period here was literally 3 weeks. For 3 weeks, the market collapsed for 3 weeks. And then one of the biggest, fastest rallies ever after that. everyone was panicked with COVID. Pulled back to support, major uptrend. This was my most profitable year of trading ever, because we got our market internals buys all down here. After this pullback, down here is when we got the market internals trade signals down here. So when it started rallying, the market internals happen after the market goes down. We will got them down here, our buy signals. When they rallied, there was such big, massive rally and gaps. We're getting 60-70% return on our trade at the first profit objective, which is normally might be 15, 20, 30%. We were literally doubling that and then some with these options as the markets rallied off of these lows, because the volatility was just massive gaps. Best trading in 2020 when COVID shut down everything. Trading was the best, and you can see it. If this was 2022, market pulled back. People were freaking out about, we're going into a recession, we're doing this, we're doing that, we're doing that. You know, every couple of years, markets will pull back to major support and right back above, pull back to major support, right back above, uptrend never broken. We're in this massive uptrend. We've been this massive uptrend since 2009. It's only been broken for a couple of weeks at a time during that period. And that's it. So here we are right again, still a massive uptrend in play. Eventually, we will pull back again. And you're going to hear it on TV, the sky is falling, recession this, elections this, whatever it might be. And whatever they say, who cares? That's why we look at everything objectively, big picture only. And eventually the markets will pull back. As this goes up, it'll pull back and it'll get all scare a few people. But if you understand the big picture, you don't really care, right? So let's go ahead and get to the daily charts and the market internals. And let's take a look at one of the trades that's on the, so I'm going to switch back real quick to the handout. Okay, so on your handouts, you have the list. So we're going to focus on the cues for today for this one particular strategy. Like I said, we trade multiple symbols, and I'll show you some of those trades in a little bit for this year. But we'll focus on the cues and take a look at how we make money doing this. So I had Becky put together this listing. So anything you see, numbers in little rectangles and words in little rectangles, is done by Becky. Becky does all the spreadsheeting, all the record keeping. She tracks all the numbers, all the stats and everything. So Becky is the one who handles all of this stuff. I do not type things into little boxes on spreadsheets. I actually hate that. If trading required me to do spreadsheets, I would never be a trader. Okay. When I'm putting together my trades on my futures, I do not spreadsheet. I do, however, just put stuff right onto a little piece of paper with all my trades and parameters. I just list it all out. I know what I'm doing. But I don't spreadsheet. I just write everything down, what I'm trading, entry, exits, the whole deal, stop losses. I just write it down, but that's me. Some people really like to track things on spreadsheets. I'm not one of those people. So you always have to do what works for you, always what works for you. I know people who like to do a really creative spreadsheet. Some people who have logbooks, the old engineering notebook types with the binder, and they just write everything in their notebooks. Perfect. Whatever works for you. Okay. So let's take a look at the first trade that's on 3. It's in March 23. I'm going to switch back to the charts now. I'll be referencing that table from time to time for the dates. Okay. I think this is the one I put onto the handout also. So let's take a look at the data box on the side. Trigger lines. Trigger lines. This doing a bullish crossover. This is the bearish cross when it crosses down. Bullish cross. So this is when doing a bullish cross. Bullish cross. This is plot 1. This is plot 2. When plot 1 crosses below plot 2, we're in a bearish cross. This is now plot 1. When plot 1 crosses back above plot 2, this is now plot 1. So in a bullish cross, it's plot 1. This is plot 2. In a bearish cross, this is plot 1. This is plot 2. Okay.
I might have missed it, but what are the lines? Is it which EMAs is the plot 1 and plot 2?
Okay, this is not an EMA, it's a trigger. The trigger lines are a linear regression line.
Oh, okay.
So plot 2, during the bullish crossover, plot 2 is a linear regression line, and plot 1 is an 8-period moving average of plot 2. So this is a linear regression line, and this is a moving average of the linear regression line. It's something we started using years ago because it's a great, great indicator of trend. Great indicator of trend. So we use trigger lines a lot in our futures, options, and Forex trades, and shares also, because they track trends so beautifully, beautifully, beautifully. Okay. So it's a staple on our charts also, along with the 40. So if you take a look, this is NinjaTrader. This platform is NinjaTrader. It can be used on Thinkorswim and other platforms that have this also. Or you can create it yourself if you know how to program your platform. But the linear regression line, I think, exists on most platforms. And for the 8-period moving average, you may have to create that as a moving average of the linear regression line.
Okay, thank you.
Anyone I'm working with, I will give you all the indicators all set up and charts all set up for every strategy that we're doing for Thinkorswim and for NinjaTrader. So you'll see on crossover days, you're going to see all 4 numbers filled in, plot 1 and plot 2. You'll see all on days where the 2 lines cross. You see here, lines didn't cross, lines didn't cross, lines didn't cross, lines didn't cross, lines didn't cross. Lines crossed, all 4 numbers are filled in. All 4 numbers here get filled in. That's the quick visual reference. That's the crossover. Now, how we do everything with profit objectives. We don't even consider trades where we expect less than 84% winning trades. And that's based upon an ATR target being hit. We do not do option analysis. We want to understand how options work, but we don't do option analysis. There are no risk graphs to look at. There are no spreads. This is not a spread. This is a pure directional strategy where you buy call options. That's it, with approximately 1 month worth of time. Okay. When we have this strategy valid, we expect a move fairly quickly. If you want to go out 2 months for options, that's okay. You'll raise your upfront cost, but you have a high probability that you're going to get a winning trade. But we expect this to move fairly quickly. So you usually have 1 to 6 or 7 weeks worth of time, 1 month to 6 or 7 weeks worth of time in your option. And how big a target you have is dependent on the stats, because in our trading plan, you'll have the win-loss stats. If a 1 ATR target is used, we'll have the win-loss stats if a bigger target is used. You make a decision. So ATR, does anyone not know what ATR is? You either type it in or say it. Does anyone not know what ATR is, average true range? Does anyone not know what it is? Anyone not know? Okay, and I assume everyone has an idea what ATR is. So on this day, I need someone to pull out a calculator, please, and be ready. I'm going to make a need you to make a calculation. So we're going to be here until someone makes a calculation. Have a calculator ready to go. Whether it's on your phone, computer, whatever, have a calculator. On this day,
I don't know what it is.
okay. ATR. ATR is average true range. What that means is, and we use a 5-period ATR in all of our strategies. That means on average, every 5 days, this underlying instrument moves that much from high to low. So on this day, the ATR is $6.61. That's in a data box. So that tells me that is the volatility on that day of the QQQs. It's telling me on average, on every 5 days on average, the QQQ is moving $6.61. It's a measure of volatility of the underlying ETF. That's how we base our profit objectives. We don't do volatility of options. We do the volatility of the underlying product, which is the ETF. How much is it moving? Once we know that, now we can go and determine how big a move we think is going to make within a given amount of time. Because we know it's moving $6.61 every 5 days. And we just need direction now. The technical strategies we use is how we determine direction of movement. Okay. So based upon the ATR, we know it's moving $6.61. Based on the technical setup, we have a direction. Now we need a confirmation. Here's where the put-call ratio comes into play. So everything we do is set up, trigger, trade management. Once again, terminology and from Jake Bernstein. The setup is visually what we look for. So here's what we were looking for each day. You look for the chart. Is there a crossover? No. Next day, the crossover? No. Next day, the crossover, you can kind of tell, oh yeah, it did cross it. You see I'm touching, you can't really tell with your eyes, so you look at the data box, you say, hey, yeah, they did cross. Plot 1 is now above plot 2. We have a crossover. So now we look at our trading plan. Our trading plan says that if we have this crossover and we have a put call ratio that's either 1.0 or higher or 0.85 or lower, then there's a 90-something% chance that this ETF will go higher by at least $6.61 sometime in the next month. Okay. When we see the setup, the 2 lines crossing, the trigger lines cross, that's our setup, our visual. That's all it takes. The visual, quick review. Boom, 2 lines crossed. So okay, we see the 2 lines. Okay, so now we check the trigger. Okay, we saw that the put call ratio, you go to the exchange website and you see the put call ratio is within that limit of it's either 1.0 or higher or 0.85 or lower. Great. It's not in that middle area, which we do nothing, but at the higher or lower levels, which are the extremes. If you picture a bell curve where you got the middle and the little part of the end on either side, we trade the extremes. We don't trade what's in the middle. We trade the extremes of that bell curve or the put call ratio, not what's all clumped in the middle. So now we know, we know how much is going to move. Our entry for this trade is going to be at the open price of the ETF the very next day or lower. So now I need to put someone with a calculator. The next day, if you take a look at the data box, the next day, the Qs opened at 298 even. It's gonna be easy calculation. What is 298 plus $6.61? What is 298 plus $6.61? $298 plus $6.61 is what? Please type it in. Someone with a calculator. Okay. Okay, man. 303.61. That doesn't sound right.
I'm a
There you
dollar.
go.
I'm a dollar off.
That happens in real life too, okay? Good example, that happens in real life. Were you doing the math in your head or calculator?
I was doing it in my head.
That's what I see. That's what, doesn't matter how brilliant you are. I always tell people, when it comes to trading, do not do the math in your head. Use a calculator, because it might be simple. This was actual simple math here, but when it comes to trading, you can't have mistakes. It'll kill you. And little things like that, always use even if you're great at math, and use the calculator and verify everything with the calculator. Even if you think it's simple math, use the calculator, because that happens in real life too, with real trades. All right, so what I now know, I have my entry is going to be at the open price this day or lower. I'm going to be buying in the money call options, the very first strike in the money. If the market opened at 298 even, then I'm looking at right about a 298 to 298 strike. Okay. Now, what I would do, I'm going to buy the 298 strike option 1 month out. This is March. I'd be looking at an April option. Okay, so now let's say I bought an option. It's now sitting in my account. What I do next is place an order to sell my option contract. Let's just say I'm doing one contract for this moment. I have one target. I'm going to sell my option contract when QQQ is at or above $304.61. So I bought the market opened while it's trading at or below the open. So when the market opens, while the market is at or below the open this morning on this day, I'm going to go ahead and buy my call options, and it'll be the 298 strike. Okay. If assuming it open right at, assuming getting right at the open, that's the right at the right at the money, or first strike in the money. So the 298 strike. And literally that high that day is 307.18. And our target was 304.61. So within a few hours, my first profit target is hit. If I only have one target, I'm out of this trade within a couple hours. If I only have one target, I could have bought one contract, 2 contracts, 10 contracts, whatever my risk is. If I'm risking $1,000 a trade, I'm only going to buy $1,000 worth of call options. If I'm risking $700 worth of per trade, I'm only buying $700 worth. If I'm risking $5,000 per trade, then I'm buying $5,000 worth of call contracts. That shouldn't represent more than maybe 2 or 3% of your account. So if you take a loss, it's never a big loss, always 2 or 3% of your account, max risk. All right. So I put my order in, I bought my call options, I put my order in, I go about my life, nothing to do. Once you place your orders, good till cancel, you place your order, sell my contract when the target is reached. That's it. You walk away, and a couple hours later, you get a message from your broker, hey, trade executed, and there's money in your account. A move like this, that quickly, you're looking at a 20 to 30% return like that on your money, that quickly, at least 20, 30% return, maybe more. All right. How do you get really more? With the market internals, you always have to assume you're buying a bottom. Just always assume you're buying a bottom. If you can afford it, have more than one contract so that you can trail a stop loss on the remaining contracts. So let's take a look at what we would do here. Let's say we're buying 2 contracts. We bought 2 contracts at the open or lower. On the first contract, you put in your first target to sell your 1 contract when the QQQ gets to at or above $304.61. A couple hours that target's reached, you get a message, text or email. trade executed, and there's money in your account. But if you have one more contract, okay, you got in that contract down here. You're now up here someplace, 304. You are in this neighborhood right here is where that target got hit, right around here, 304.60 something. So what you do, whatever your purchase price for the option was down here, you put a stop loss in on the option now. We no longer care about the ETF. Up to the first target, we're trading based on the ETF price. After the first target, we're now managing the option. We're now managing the option contract which remain. So let's say you had paid, just for simple math, you paid $500 for one contract. It'll be more to the Qs. Let's say you paid $500 for one contract, and at the first target, that $500 is now worth $700. It was up 40% at the first target. You sold that one contract and you booked your profits for that one contract. You still have one contract left. That one contract is up 40%. If you paid $500 for it, it's now up to $700. So you paid $500 here, it's worth $700 here. What do? You put your stop loss in somewhere above the price you paid for it. If you paid $500, you want to protect a certain percentage of your existing profit. I always say protect at least 20 to 50% of your profit, not at the price of the ETF or the price of the option, of your profit. So if you paid $500 for the option and it's now worth $700 here, if you want to protect 50% of your profit, you'd put your stop loss on the option at $6. So your option on the option would be at $6, your stop on the option would be at $6. That protects 50% of your profit. Okay, 50% of your profit. So no matter what, if the price comes back down, you're still going to get your profit locked in. Your profit's already locked in on the option. Comes down, stops you out, you're out. The looser you stop, the longer you can stay in this trade. If you have a 20% stop, your stop's going to be somewhere right around here on the profit, or even a little bit lower, but that keeps you in a trade longer. And you always have a secondary target. I like to try to double my money on this, on a second target. So if I paid $5, you have a secondary target of $10. So I double my money on it. So the market's going up, 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 probably somewhere within this range, the option price will double. Somewhere here, the option price will double on the remaining contracts. Okay. That's how that's why the market internals especially can be very, very profitable if you're trading multiple contracts. Because quite often you will catch a market bottom. Internals are our very first buy signal. So we try to milk those as much as you can to get the most out of them, because on our other strategies, you might get on a winning trade, depending on some decisions you make or where you get in, you're looking at anywhere from a 10 to 20 something, maybe 30% return. If you get creative, where I tell you to do it on some of those, that 50 to 20 can become 25, 30, 40, 50%. But these are all usually can go higher faster, because they're getting in at the bottom and volleying off the bottom. So whenever you get a market pullback, it usually is followed by a nice rally where you can book a lot of profits really fast if you've managed things properly. And the market internals are great at that. Okay. Any questions so far on any of this? I'm only going over this one strategy from the market internals group of 6 strategies. All right, so let's take a look at another previous date, 11/11/22. There are other trades in here where you see crossovers. You can go ahead and assume somewhere here we'll get another buy signal from one of the different market internal strategies, plus our other option strategies. Okay, so it's not just one strategy. We may not catch this with this strategy, but one of the other market internals are going to be giving you buy signals in this area with one of the other buy market internals. And then our other regular technical strategies will kick in right about here. All right, so let's take a look at the one from November. That's 11/11. This one right here, 11/11. So on this one, ATR is $9.14. You're going to get in the very next day. Pull out a calculator, please. Calculators. The open price the next day is 285.86. Open price is 285.86 against 285.86. Added to the ATR on this day, 9.14. So what is 9.14 added to 285.86? So what is 9.14 added to 285.86? I got John saying it's 295. Okay. So you get in at or below the open. The market opens, it goes up. Let's say you get in by the time you, let's say it opened at 285.86. But when you get to it, the market's up here someplace. Do not place the order. Do not place the trade. The order is to be placed. Get into the option when it is at or below the open. If you get in, if you miss the trade, you miss the trade. Sometimes it'll open and take off without you. If you miss the trade, you miss the trade. Life goes on. You wait till the next trade. But it opened, and then eventually it comes down to below the open, and you get in anywhere down here. This one would have been a 285 option, would be the first in the money, but it got as low as 284. So 285 option would have been the one in the money. Now, John says our target is 295. This day, the high was 289.21, so the first target was not hit the first day. The second day, the high was 293.26, so the target was not hit this day. Market went against you for a couple of weeks, and then boom. Take a look at what happens here. The market closed this day. Let's see, did it get high here? High, 295.75. So this is the day that your target got hit. It took what, a little over 2 weeks. On this day, your target got hit. You get into, you got your trade signal here, entered the market here. A little over 2 weeks later, after a massive rally the very next day, did it hit here, 293. During this day, it got hit and you're out of your position if you're just trading the first target. If you're trading multiple contracts, multiple targets, well, you're going to have your stop loss in probably somewhere around here. You're getting in down here. Your first target is hit up here. If you're trading multiple targets, you put your stop loss 20 to 50% of profit, which puts your stop loss right around here. Market comes down the next day, hits your target, your stop loss, and you're out. On the remaining contracts, just book whatever profits you had on those contracts and you're out. Question here. What if target wasn't hit and trigger lines cross again? The only thing the trigger lines do is find you potential entries. The indicators have no purpose in any way, shape, or form whatsoever after finding you the opportunity. The indicators on all strategies, on all charts, are only used to find you potential trade setups, which is potential trade to get into. They have no usage in any way whatsoever for trade management or any trading decisions whatsoever other than finding you the opportunity. Okay. Once you find the opportunity, you actually have to know what you are doing. The indicators do not help you. You actually have to know how to trade. You have to know how to manage risk. You have to know how to allocate the money in your account so that you don't get wiped out if one trade goes horribly wrong. You have to know how to track your positions and trades. If you're trading multiple contracts, multiple ETFs, multiple whatever, you actually have to know what you're doing. So that's where coaching you comes into play and working with you one-on-one so that you actually know what you're doing. This part is the easy part. Finding two lines crossing, that's the easy part, okay? Finding two lines crossing, that's easy. That's not trading. This is just technical analysis. I found my opportunity. Now you actually have to know how to trade, have to develop the mindset, the business approach, the discipline, and all the other things that go with trading to actually make this work. Remember, trading is not just finding two lines crossing, thinking you're going to make money. It doesn't work like that. You have to also understand how, I just can't go buy an option in the money. It might be too expensive because we're talking options here. So there are rules that I go over with people when I'm working with them one-on-one. How much is too expensive? Because you can't, anyone who's traded options knows that if you pay too much for an option, don't have the right amount of time and everything else, it can just decay against you, and you're going to lose so much money on time decay. Even if your target is hit, you got nothing. You lost all your money. So everything is very specific, including how we determine option pricing. It's very rules-based. Your option cannot cost more than a certain amount of time. Both myself and Becky spent a lot of time doing Gann time and price analysis. A lot of people focus their energy on price. What I learned with Gann analysis is if you factor in time also, so price and time, wow, you can get some, your trading gets exponentially better because your trade should take so long to get to a profit objective. And if it's not getting to a profit objective within a certain amount of time, then something's wrong. The trade isn't working. So all that knowledge base is all incorporated into our strategies, where we look at price and we look at time. And with options, times become extra important because as every day goes by, your options are worth less and less. So whatever we do, we have to expect our price to be reached, our target price to be reached within a certain given amount of time for all these strategies to work. And that's why everything we do is 84% of wins are high, because we've been doing it for so long. So we know it works. It's not even a question. We know it works. This plus our regular strategies that are not the market internals. All right, so like I said, this sort of happens over and over again. Take a look at, let's see, let's go back a little ways to 2020, when the market just got crushed at the beginning of the year. 2/4/20. They just scroll back and take a look at when those wins happen. Let's see where we are. Is this 2020? Okay, we had one trade here on 2/4. Gap the next day. That's the entry. So anytime this day, at or below the open price, you get a first in the money. If it opened that day at 2:30, so that'd be the 2:30 strike. But if you got in later in the day, it dropped as low as 226. You could have gotten in the 226 or the 225 or the 227 strike as it went down. The first, and it got lower. So let's say it opened at 230.22 and your target was going to be 389. If you get in 1 point lower, then your target can now be $4.89 rather than 389. If you got in 2 points lower than the open, then your target can now be 589 rather than 389. By getting in lower than expected, you can now, your target's bigger, so now you can actually get even more profits because your target got even that much bigger, okay? So when you get into the trade, you could have gotten in this point 3-4 points lower than expected and have that much bigger of a target, all gets hit. One quick, easy way, most of my trades look like that, by the way. I don't get in right at the open. I get in after the market's dropped a bit, so then I have a bigger target. So I have much more profits than the minimal profit. I get a lot more because I get it on a price lower always. Okay. Next one after that in 2020 was 331. Remember I said after the market just crushed? After the market, by the way, we had trades going on all the way down here too. We had short trades. We shorted the very tops of these markets. Now with this strategy is one of the other strategies in our primary group of strategies. We were short all the way down to a point where, see these gaps? A gap from this day to that day gave us a 60-something% return on our first target. And then a gap the next day, and the next day was ridiculous with our put options just doubling in value. It was, people were like, are there any new sell signals? No, we exhausted them all. We literally had so many shorts going on, going way beyond targets. People were out of their positions, wishing they had more options to trade. So we made money all the way down so profitably that it was big enough profits on coming down on these wins to overcome other losses that happened. Okay, they just negated other losses. 1 or 2 wins would negate several losses. It just got so big. 331 after the market in 2020 got crushed, destroyed after COVID shut down. Here we are, right here, the end of March. 330. And our, excuse me, 331, 331. That's our trade signal this day. Gaps down, we get in the first in the money strike. This is the picture of money. This gap right here, this is what money looks like because it never pulls back to stop you out. You're going to get your first target hit pretty in a couple of days. And then if you're trading multiple contracts, you just trail your stop. Your second target, you're gonna double your money on the second part of your contracts. If you're trading thirds, you're gonna triple your money. So some people trade one target only, then it'd be out of the first target. Some people like to have a second one on. I always recommend with the market internals have more than one target and more than one contract, because quite often it'll be like this, where you can get a double your money on the second part of your trade. And if you're trading thirds, if you have a big enough account, can afford 3 sets of contracts and targets, then this is the type of trade where you triple your money on the last third. Okay, or you can have it open-ended, because you never know when you're going to catch a big trend. Once you have profit locked in, then you have a lot of flexibility on how you manage, so you can actually trail a stop. But this was just super profitable trading. That's why COVID times was literally my most profitable year of trading was 2020. Hands down, most profitable year of trading for me ever. I also didn't have anything else to do. I had nowhere to go and nothing to do but trade. So I was like, all my other sources of income was shut down. This was it. So I was hyper focused on being in my trades every day. I didn't have anything else to do. This was it. I had no other income. Trading was it. Everything else is done. Just like right now, I'm SAG-AFTRA, by the way, and I'm on strike. So I got no acting work, no stunt work. I got no film or commercial work for a while until that's going to take a couple of months. So I have much more free time right now because that part of my reality is currently on strike with SAG-AFTRA. And it'll take them a couple of months to resolve all of that, and then I can get back to working on commercials and films again. Did several this year. Did one about 2 weeks ago for a healthcare company, a commercial. Did a Ford commercial several months ago. Just did some other stunt related activities, some behind the scenes stuff, planning, some fight scenes for film that's being shot in Sacramento. So it's right now, it's all kind of on hold. Hopefully they'll be able to resolve all that stuff fairly soon. Right. Do we have any questions on any of this so far? I said, it's just one strategy. And those of you who don't already know it, what I do, I email out to everyone who I'm coaching the trade signals, which we found valid each day from myself and Becky. And then you use that to compare with what you find valid. So we do the futures in the afternoon and the options and ETFs in the evening. And we do that for you for at least the first 9 months for all the coaching clients to get you, make sure that your trading is going well, that you help you as much as you can, get your routine down for evaluating the markets each day, and really make sure you are set with that. I encourage people to contact me to have me take a look at your trades on a regular basis, monthly, at least, to make sure that what you're doing is correct. What I found is that there are people who will think they're doing everything right, and then they start getting losses, and they blame everyone except themselves. They'll be like, this strategy sucks. He didn't know what he was talking about. I'm just losing money now. No, it's because you're doing something wrong and didn't realize you were doing something wrong. That's why I encourage people to have me take a look, review your trades with you at least once a month when we're getting started, to make sure that things are, that you're actually doing stuff the way you really should be, because you might think you are, but sometimes it's just not right, and you will just getting lucky. Okay, so we don't want to make money by being lucky. We want to make money by doing things in a business-like manner with an expected outcome. All right, I'm going to switch over to show you the trades that have been valid for this year, so you can see what's been happening with market internals this year. Let's see. All right, this is the trades for this year so far. We have 30-something trades and 1 loss. And this is right through beginning of July. These are the dates so far valid this year. It's just been a great year, another great year for the market internals. So when you combine market internals trades along with your other strategies, these are really the most profitable because of the amount of time. These are the lowest price options versus the other strategies, because we require less time in these options, whether you would trade the strategies in those 2 expiration cycles. These can require less time, which means you don't have to pay as much upfront for the option. So when you have a win, you're actually booking a much higher percentage return on your money. So that's why I really like the market internals, because you get a higher return on your money, because these tend to move faster. Okay, that put call ratio is really great at short-term, at confirming short-term movements in the market. We still need our buy and sell, our buy signals, and we have multiple buy signals, usually after the market's dropped. But when you combine them with the put call ratio, it just amplifies the effectiveness of the buy signal. So that's why we have this grouping just for those set of buy signals. All right, any questions so far on any of this? One more quick spreadsheet here. Feel free to unmute and ask questions too. You don't have to type it in. You can type it or ask a question. Pretend you are live in person. We haven't had an in-person meeting since 2020, but pretend you're in person, ask a question. Don't raise your hand, I won't see it. Just ask a question, anything you want. Let's see. This is from the CBOE Options Exchange. Becky tracks this, keeps a track of the put call ratios every day. She puts them into a spreadsheet. Up until, let's see what's the date here. Up until 2019, the CBOE would put in all the values every day into one spreadsheet. They used to put all these values into one spreadsheet, and then several years ago they stopped doing the spreadsheet thing and just started posting just the final number. So Becky basically kept the spreadsheet going and just puts the number in the spreadsheet. So we know on 713 this was the put call ratio, 712 that was the put call ratio, and that criteria we showed in the. I'm going to go back to the trading plan. a moment, but that's the listing of put call ratio that Becky keeps track of that for ease of our use here. This is she does a good job of keeping track of all that stuff for us. Okay. So that's just this first value. They no longer have the spreadsheet with all the historical trades that update every day. All they do is update the most current day. These literally update a spreadsheet every day with all this information. But now all they do is update this one page. So if you want information, you can go back any particular day you want and click on that particular day, and it'll show you the put call ratio. Then that was July 4th, July 5th. It'll show you on July 5th, it'll show you the put call ratio for that day, and go back months if I want. December 7th, that's the put call ratio for that day. So, and this goes back, I think, to 2006, I think, or further. So this is where you find the put call ratio on this site. That's the same link that's in the chat window and on the handout. In the handout, it is right here. That's the site on the handout. It's a screenshot from the website. Sample trading plan to show you. Now, when we do a real coaching session, there'll be a lot more detail we go into. You'll have, this is just a real general. The real trading plan has more detail, has the stats, it has more stuff, and this trade measure we go into a lot more specific. So this is just a general reference, but in real training, we go into this in much more detail so you fully understand everything you're doing. And you got to understand it. You can't, like I said, finding the setup and trigger is easy. This, you actually have to understand what you're doing to know how to trade. You actually have to know how to trade, how to do all this, what everything means if you want long-term success, and you have to be able to do it on your own. This is a solitary business. If you lost all your money trading, literally nobody cares. Your friends and family will tell you you're gambling. They won't care if you lose your money, okay? That's why you have to find your own support group among us quite often, okay? I have my website here. This is our trading group. And so I have members, coaching clients as part of our group here. This is coming up soon too for people who really want to set up a corporate accounts and trade as a business. This is coming up. I'm not sure if it's happened or not yet. I don't recall. It might have been this past week. But information I put in here for workshops coming up and other things, questions being asked, how to set up trade as a business, as an LLC and corporation. People ask me that all the time. That was a free training, 3-day event. But a lot of stuff happens, and I make sure people know about it. If you want to ask questions, you post it within our group. I'm always available by phone, email, or Zoom. So I'm really easy to contact. Okay. On our website, this is where we have the handouts, listing of valid trades. On the homepage, I had an image here, something to take a look at when you get a chance. Did it in the previous presentation also. I have a NASDAQ in 2020 with all the trades valid that whole year. And it's a good exercise to go through with anyone trading these strategies, is to lay out all the trades on one thing. This includes the market internals. Under QQQs, there were 41 trades and 3 losses in 2020. This is with all the strategies combined. So people trading everything who want to take all the trades. Some people, I did QQQ specifically for this because I was working with someone and they told me they only want to trade the Qs. I'm like, we have 28 ETFs. And they told me they don't care about the other ETFs, all they want to trade the Qs. Yeah, but you're only going to have maybe 1-2 trades a month. And they said, well, that was okay. 1, 2, 3 trades a month is fine. I'm like, yeah, okay. So I laid this out for them just so everyone, so they could see it. And this is what it looks like. It was literally, this is what the queues always looks like, by the way. That's why if you want to specialize in something and just place bigger percentage trades, but only on fewer things, this is what your trading can look like. This is not 2% account risk per trade. This is a higher percentage per trade because you're only trading one thing. But you have multiple trades going on the same instrument, and it's just like win after win after win, and you manage this. And but this is what they wanted to do, so I laid it all out so they can understand it. And but it's always beautiful when you trade fewer things and get really focused on fewer things, and then you can, rather than trading more, you trade less, just trade bigger. And that's something to evolve to. Don't trade more efficiently. And then you take bigger trades, not take a lot of trades, but fewer trades and better trades. That should be a goal, long-term goal. That's what I do now. I don't look for every trade that comes valid. I trade a certain set of ETFs. That's it. Trade a certain set of futures. That's it. And that gives me my most consistent profitability. And I can plan ahead my income, because it's just a subset. Everyone wants to start out trying to trade everything. It's just too much. You get real focused, become a specialist, and it's cha-ching. So, like I said, this is a list of trades just for QQQs over the last years. And if anyone is interested in working with me on the market internals or our other strategies, which I think some of you have seen, just to show you that real quick. The stats. Most of you seen these, but these are like the win-loss stats for one of the T-line setups. If it's in light blue, it means 84% or higher. These are the different ETFs. And this is the amount of time in the option. This is 2 expiration cycles, 1 expiration cycle. So the less time, the higher chance you're going to have a loss. Okay. The more time, the better a chance you will have a win. That's simple. A little bit higher upfront cost, but I'd rather have a win than have a loss that I have to make up for with extra wins. So we maintain these stats for people. Another one for one of the short setups. One of our hook setups. So if I get a hook valid on EWH, which is Hong Kong, I'm going to pass. It's less than 84. But if I get one valid on EFA, 92% or 100%, I'm good either way. Never had a loss. That type of thing. So, and this is one strategy for buying market bottoms following a pullback. This is one we always look for in addition to the market internals. And this is our strategy for shorting market tops. This is our first sell signal at every market rally will end with this trade signal. Every single market rally will, whether short-term or long-term decline, will start with this signal. Okay, so this is how we buy our puts at the very, very top of the market before volatility kicks in and makes them expensive. With this strategy, this is how we short markets. I could do this and no other strategy and be happy. I could short markets and nothing else and be happy with this one strategy. And some people, who specialize in shorts, this is a great strategy for that. I'm gonna switch back to the plan. Okay, so anyone interested in working with me on that, the cost is $17.50 for the daily chart strategies. Some of you have seen these before, but it's that group of strategies where we trade long, we trade short. I work with everyone one-on-one, whether it's in person or on Zoom. I'm available by phone, email, I'm pretty readily available at different times of the day and week. The only time I don't do any training is on Saturdays. Saturday is my time. So I don't do any coaching on Saturdays. But the rest of the week, and usually not Thursdays either. So Thursday and Saturday, because the Thursday I'm less busy on Thursdays. But Monday through Wednesday and Friday afternoons, I'm available. And Sunday afternoons, I'm available. This thing is one more day in there somewhere. All right, so, but it takes, I do ask you to commit to 3 to 6 months of trading the strategies, because you really have to understand how the profit and loss works. You will have losses, guaranteed you will have losses. But you have to go through a 3 to 6 month period to see how the numbers work themselves out, and to really appreciate it and be able to get through to the other side. And then once you do that, with my help, with me looking at your trades, if you try to lose money silently, what I found is if I don't hear from people for a while, it's because they were losing money, and quite often they are embarrassed to tell me they went off plan, started doing stuff randomly that wasn't following the plan, and they lost a bunch of money. And quite often they are just embarrassed to let me know that they did not follow the plan. If they followed the plan, it would have been fine. Let me know, because part of this is me helping you with that mindset to keep you on track and keep you on plan, because doing this by yourself is really tough. That's why working with someone that you have to be communicate with and verify what you're doing and commit to this with someone else, it helps a lot, whether it's in a group or one-on-one with me. It helps to be doing this in conjunction with someone else. Really, really does. And we meet in Santa Clara or online. I like to meet in person if at all possible in Santa Clara. Otherwise, we meet online with Zoom, good old Zoom. And the full program, that's with the daily chart strategies, the weekly chart strategies, and the market internals is $39.95. I will take $500 off of this price if anyone is interested in doing all of them. Similar deal if you want to do just the daily chart strategies plus the futures. It'll be a similar pricing where I will take $500 off the two for the futures and options together. That's actually the best combo when you do futures and options together. For this price, I'll take $100 off of this. For anyone in my meetup group, let me know before the week is over. I work with you one-on-one. I will help you get all your charts set up, whether it's NinjaTrader and or Thinkorswim or whatever other platform you might be using. I'll help you with that. But this is how I work with people one-on-one only, no big groups. Everyone's different. Some people learn quickly. Some people literally talk to once. I've met once, literally once, never heard from them again. I'm like, and then I talk to them like years later. Oh yeah, it's been going great. I'm like, okay. So some people contact me every day, every week. I'm like, great. I don't cut people off after 3 to 6 months. I always, in here it says like 6 to 9 months of coaching. Nah, it's like you need help. There are people on the meetup right now. If they wanted to meet with me next week, I'll meet with them next week. They've been working with me for 7, 8, 9 years. Not a problem. I'm local, they're local. You need help, I'll help you. It's not a big deal. The stuff we do around here, part of the local trading group. So I see people semi-regularly. So if you need help, just let me know. And I don't put a time limit on any of this stuff. There's one guy who emails me every week since 2008. He's emailed me every week to verify his trades. I talk about him once in a while. His name is Steve. He used to be one of my coworkers at Lockheed, and he was literally the first person who I taught how to trade. The very first person I taught how to trade. He trades shares, ETF shares. He trades stocks. He trades options. He traded futures and Forex. He's settled in right now on shares and options. But he checks with me every single week to make sure his trades match my trades. And he's been doing that since 2007 or 8, right till now. And I don't charge him anything. It's just, he's student number 1, but he knows, he's learned, you can't trust charts. You can't trust data. Just because something looks good on your chart doesn't mean it's correct. We know that charts have errors. Sometimes data doesn't update correctly. And unless you are working with someone else, you don't know that your data is incorrect, and you make decisions based on your chart, and you don't know your chart is incorrect. You don't know the broker had errors or problems on their platform and where there were bad executions. You will never know unless you are communicating with other people. That stuff happens all the time. So unless you talk to other people and say, hey, I got a really bad feel on this. What happened here? And I'm like, you need to talk with the broker because there's something off there, and they'll talk to the broker and say, yeah, there was something off there. But the broker won't offer the information. You have to ask about it. And then when you ask, like, oh yeah, we'll fix that for you. And they can fix trades for you. I've had multiple trades corrected by the broker where I had a loss and they turned it into a win. Other people do the same thing, but you have to be an advocate for yourself. You have to recognize that there's a problem here. That's one of the big points of having me review your trades also. So we can see situations where you might need to speak with your broker because something wasn't right. All right. So do you have any questions? Now, during meetups, I do a lot of lecturing. In real life, during trainings, it ain't lecturing. It's I lead you so you can understand and make sure you do the talking, you can do the math, you can understand what you're doing, you know how to find the option volatility, how to get open interest, how to get a delta, whatever we need to, how to find the option volume, how to calculate the intrinsic value, extrinsic value, because you're going to need that in making your determination of option pricing. So little things like that I work with you on one-on-one and make sure you know how to do it. I don't lecture that to you. I guide you, make sure you know how to follow and do that. All right, so do we have any questions at all? Anything whatsoever, including previous things, anything you want? Probably going to do another meetup in about 2 weeks. Haven't decided yet if it's going to be on futures or options, but more people are still asking me about futures right now, and it's good to be doing both. And our futures are better than ever, especially currency futures. The currency futures have been consistently profitable. Last year was a negative on the index futures, but the currency futures were still great. They are all the time, and you can actually trade with a smaller account. So if you have a smaller account, a couple $1,000s, you can trade effectively with the currency futures, which you can't do with options. Need more money for options. But the currency futures, you can actually trade much smaller size and have a very, very nice return, then build it up as you go along by adding more capital as you need to. But you can learn the smaller account with the currency futures, with taking risk as little as $100-something per trade, and be very effective. All right, so if you don't have any questions, I'm going to go and end this meeting for now. We'll resume in about 2 weeks for our next one, either on futures or options. I'll decide in the next couple of days. If you want to talk to me about coaching, the information is here. It's also in the handouts, also on our website. So if you take a look on our website, all the details are there on the pricing. Same exact thing. I'll take $100 off for the options. This is for options and futures, excuse me, full on everything options. And this is for the futures only. And this is the probably the most popular one a lot of people do with me are the futures and options. And anyone who wants to do both of these futures and options with me, I will take $500 off this price. If you're in my meetup, let me know before this week is over. This will take several months to fully implement, because depends on how much time you have to put in. It will take time for the futures and then time for the options. So I'll take $500 off this price. If you want to do that, let me know, and we can start planning. So either the options program by itself, or you want to do options and futures, we can start planning that now and implement it slowly but surely. The best time to trade, as I always say, is going to be October through April. So gearing up now to be ready for October through April is always the best idea. Those are our most profitable months to book profits. And that has not changed in a long time. And why is that? Because that's when we get the biggest trends. We get great trends from October through April. So it's not just first targets, but first targets and then some. So now's a good time to start gearing up, get all your details worked out now to be ready for that October end of year timeframe. And so learn now and be ready. So if you have any questions, email me, call me. I'm very available by phone or by email, or you can also use the contact form on our website. Just fill it out. It's a good, quick way of messaging me also on the contact form. And unless we have any questions, I'll go ahead and end the meeting now, and you guys can contact me as needed. Otherwise, I'll see you all in 2 weeks. Hopefully we can all get ready for the fall and, like I said, trading, most profitable. Just be ready for it. Learn now, be ready for it in that October timeframe. It's the same every year. Absolute most profitable time to trade, October through April. All right, see you guys in 2 weeks.